Welcome to the latest Motley Fool Scoreboard. I'm Anand Chokkavelu, and we've got longtime fools, Lou Whiteman and Matt Frankel, giving a 1 to 10 rating to a company we've used over the years at the Motley Fool. It's Braze, ticker symbol BRZE. First, we'll talk about the strength of Braze's business, including factors like industry, competition. A 10 is invincible, a 1 is hopeless, 7's from both of you, Matt.
Yeah, I probably would have given it a higher score if it was a profitable business, and we'll get to that in a little bit. But it's a really innovative platform for companies to interact with their consumers. It does some really interesting things when it comes to tailoring, unique marketing efforts and things like that. If you've ever been shopping online and left things in your shopping cart, and then a couple hours later got an email that says like, "Hey, you left things in your shopping cart," that's one of the things that Braze does. It integrates with some of the major ad platforms like Facebook ads to really help businesses interact with their most loyal customers. Revenue has tripled in less than 4 years. It's got some great traction with customers. Shake Shack, Peloton, TurboTax, Venmo, and DraftKings are just an example of companies that use Braze.
Yeah, I don't want to like this business. I don't want any more emails and texts. Okay, I'll be honest. But that perspective tells me how effective this is, and at least they do make the text blast more relevant. It's actually something with a little intelligence behind it. I'm not going to sit here and say it isn't effective, even if I don't want to get it. And I respect what they're doing. They're filling a need, growing the customer base. The results speak for themselves. I do worry that there are bigger players here who can kind of step in. So it brought me down a little, but this is a solid business, a solid 7.
Cyber stalking company, Braze. For management, a 10 is Warren Buffett, a 1 is Homer Simpson. Lou's at a 9. Matt, you're at an 8. Those are strong.
Yeah, it's got not one but two passionate and engaged co-founders, both of whom have a lot of skin in the game. William Magnuson is CEO. He's been CEO since 2017. His co-founder is the Chief Technology Officer, CTO. The founders and leadership team combined for a 19% ownership stake, and only 5% of that is the CEO. So that's a lot of people with skin in the game. Most of the C-suite has been there since the early days. Great board quality. If they could figure out how to make this into a steadily profitable business, it would have gotten even a higher score than 8.
Yeah, Matt said it. This checks every box we talk about around here for, skin in the game, co-founders in charge, working together, all of this. I went a step higher because I'll go with, just another reason I respect these guys is they started this company back in 2011. With a real solid vision, almost like, an epiphany about how smartphones would change consumer engagement. And gosh, they were right. And, that I wasn't thinking about that in 2011. I don't know if you guys were. You do wonder, or at least I wonder, as they grow, will there be like a la the trade desk? They'll need some outside help to deal with the growth. But for now, where they are today, I don't think you could do much better than this. So a really high score for me.
For financials, a 10 is a fortress, a 1 is yikes. The high scores continue. Both of you are at 8s, Matt.
Yeah, there was a scene in the movie Blackberry when all the employees were watching Steve Jobs announce the iPhone just with jaws on the floor. And that's kind of what these guys did, to Lou's point. So I gave it an 8 for financials. Great growth. Remaining performance obligations, which is kind of a measure of future revenue, was up 26% year over year. There are a few dings. Dollar-based net retention, it's well over 100%. But it's declined significantly lately. So the acceleration is falling out, and the company is not profitable, at least on a GAAP bottom line in that way. But it's quickly getting there. The stock is down this year significantly. It dropped after the first quarter earnings report, mainly on profitability concerns, not on the ability to grow revenue. The company actually raised its revenue guidance and simultaneously cut earnings guidance, which that indicates profitability concerns. So that's why I didn't give it any higher than an 8. And that's what I'm watching going forward.
Yeah, I mean, I don't have much to add. This is about as high as I can give until they just cross that last threshold, but it should be a good score because there's so much to like here with these numbers. It's a relatively small business with just a couple thousand customers. Some people could see that as a risk. I tend to be glass half full here, where I see that as an opportunity to grow. Tons of free cash flow, lots of potential. Overall, a very solid score. Just kind of get over the last speed bump and then let's talk.
It's pretty impressive to get 8s when you're not profitable on financials. Lou, let's talk valuation. How well will Braze do over the next 5 years? And then how safe is it? 10's a sure thing, 1's a lottery ticket.
So I may not like this style of marketing, but it feels like it's here to stay, and it appears Braze is very good at it, and they will capture a bigger and bigger part of this market. So I think this can be a 15% plus winner. It's probably going to be volatile along the way. I'm glad you're giving me 5 years. My safety score is only a 4 because I do think we do have to acknowledge that other half of what I was saying before. It is a small company. Marketing trends can change. There's some risk that they might not evolve or see the next big thing. And there are big competitors in the CRM, just general space, that could at least come in and sort of try and make a feature out of their core business. So I don't think it's like lock solid safe, but it looks like a really good risk reward opportunity to me.
Yeah, I said 15% plus over the long term. I give it a 6 a safety score. I think the customer base, I mentioned a few of their big customers earlier, and some of those relationships combined with the recurring revenue model make it a little bit safer than Lou gives it credit for. And profitability wise, it's worth pointing out Braze is profitable on a free cash flow basis, significantly profitable. So it's just GAAP net income that we're talking about here. It's not a money losing business, in terms of their cash going down every quarter. So I think it's a little bit safer than Lou says.
Time for everyone's favorite topic. Lou, is there a company in Braze's space that you like better?
For this specific function, no. But back to my point on the risk, I think we should at least give a shout out to companies like Salesforce, like Adobe, who have pretty substantial marketing infrastructures and can offer this as well. You don't get the growth potential here, but you get a more rounded overall business. So that might be more appealing to some investors.
Yeah, for me, Braze is actually near the top of my watch list. I don't own the stock yet, but the more I dig into it, the more it looks kind of like a bargain priced growth stock. And it's one that I'm watching very closely.
Thank you to both Matt and to Lou. They've given Braze an overall score of 7.7 out of 10, just short of that 8.0 that would compel me to buy shares. But I'll tell you, just like Matt, it's being added to my watch list. I can have 100 stocks on my Yahoo Finance watch list, and it's going to be one of them. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is something great, I promise. Till then, Fool on.
I don't want to ding management here, but I just feel like if they went with BRZE, that would have given them just that couple of extra tenths of a point. That would have gotten them over the top.